Thank you very much for joining us today. We're going to be talking about the rise of the machines in active and ESG investing. Systematic strategies are a hot topic at the moment, dominating increasing parts of alternative investment. Quant strategies have been outperforming. We saw that during the volatility early in the pandemic and again throughout this year. Artificial intelligence and machine learning approaches are also increasingly common, and that is what this panel is going to focus on. At the same time, ESG has moved from being a footnote to a core part of the investment management landscape. So, what does the rise of the machines mean for active investment management and ESG? To answer this topic in the next 30 minutes, I have an esteemed panel. Starting at the far left, my left, your right, I have Gareth Shepherd, co-head of Voya Machine Intelligence and Portfolio Manager at Voya Investment Management. Sumali Sanyal, another portfolio manager and managing director, systematic global equities at Xponance. And on my left, Erika Karp, chief impact officer at Pathstone. So we have two portfolio managers and the chief impact officer of a family office advisory firm. Let's start by taking a step back. Sumali, why has the use of AI/machine learning become popular in the investment industry?
Thank you, Will. So, of course, you know, the cost of computing has dropped dramatically in recent years, which has spurred the adoption of AI and ML. And cloud computing is highly commoditized, so you have all of the processing power that is needed for these methodologies available online. So that has been a big driver of this popularity in the adoption of these techniques. In addition to that, you now have a lot of algorithms that are available, like open source packages, free, robust algorithms. So that has brought down barriers of knowledge, time, effort, and of course the presence of big data. That is essential for these methodologies. And for quant investors in particular, you know, the ability to have nonlinear models and nonlinear predictions is a big advantage. Up to now, most models were based on linear regressions, and those are pretty, have been used for a long time, but they don't really, they're not truly applicable in many situations. So machine learning has allowed us to look for nonlinear relationships and also to find structure in complex data that was also not previously available. So all of this has created great opportunities in investments in the area of AI and ML.
Gareth, do you want to pick up on some of those opportunities?
Yeah, sure. I think I'd reverse the question. Like, why wouldn't ML and AI dominate the investment industry from here? Like, why not? What's the best chess player in the world? Machine. What's the best Go player? Machine. What's the best driver of a car? Machine. So it's pretty obvious what the trend is for anyone sitting back, and the financial industry, especially investing, has always been the pointy end of the spear, right? So we are undergoing a revolution, a genuine revolution, and we'll look back in 10, 15 years on the way that fundamental investing used to happen and think that was crazy. People sitting in rooms reading financial reports and reading page 232, related party transactions, you know, crazy use of talent and capability. So we think it's a big part of the future. Doesn't mean that there's not a role for humans, and we can get into that. But for sure, machines are already a big part of the investment landscape. Execution, market making, CTA, passive investing, indexing, moving up the value chain to financial analysts, and then active investing. That's where we are now. So it's not even the future; it's the present.
Erika, do you think investors are on board with that message and realize the extent of the opportunities?
I think yes, but I also think maybe the extent of the risks are not recognized. Mm-hmm. Now we know we're going to, with AI and machine learning and ultimately quantum computing, we're going to be able to do fantastic things in terms of, I'll talk about impact investing or ESG analysis. This is a huge opportunity, but right now, when we have data, ESG data, that is like, frankly, really sketchy, you have a huge risk that we have bad data, systematic integration of bad data, which could lead to bad funds and bad analysis and bad ETFs and bad profit outcomes. So the risks are there, the opportunities are there, and we're going to talk about this, I think, more later. But I just want to say, unequivocally, there is no such thing as ESG investing, period. There is such a thing as ESG analysis. That's a thing. And once we have better data, sector-based material data, then we're going to have the opportunity to really use technology effectively to have impact.
So has marketing jumped the gun a little bit when it comes to ESG?
Say again?
Do you think marketing has got a bit ahead of itself when it comes to ESG?
Oh, totally.
Yeah.
Totally. And I think the nuance is, not in there. Anyone who says ESG investing, like, what is that? If we use ESG analysis, then we can do investing and impact investing, sustainable, double bottom line, triple bottom line, socially responsible investing. We are just talking about investing here with an enhanced analytical lens. Mm-hmm. So with regard to the marketing, because money's flowing, it's way ahead of the reality. And all the onslaught of negativity around ESG, so-called investing, is frankly stupid, right? It's blindingly obvious. We're just talking about more data and predictive insight if it's done properly.
Mm-hmm, mm-hmm.
Right, and I want to jump in here and talk about, you said ESG data is what matters. Then you use that data to invest, and then it becomes ESG investing, right?
Doesn't become ESG investing, it becomes investing.
Investing, exactly. So this is where I think AI and ML can play a role, is to get that data, right? Because I guess, and I'm sure pretty much everyone has read about sentiment analysis and how AI can really help in quantifying qualitative information, and also not rely only on company disclosures, right? It's more about, I think it democratizes the process of data gathering, because now you're relying on these other sources, social media, LinkedIn posts, transcripts, from earnings calls or things like that, and trying to extract information from there to see whether a company is truly doing what it says and whether they are committed to ESG. So you are kind of getting access to some solid data using these techniques, and also like preventing that greenwashing.
I guess a common complaint with ESG is that it means totally different things to different people.
Yes.
It's interpreted very differently. Gareth, can machine learning data help to offset that risk?
Yeah, exactly. And ESG, you can simplify it dramatically if you talk in the language of traditional investing, i.e., it's an alternate data set that helps enhance your investment, a view of a company, and can enhance your performance, right? If you take that view of active ESG integrated investing. So that's our philosophy, and there's a lot of value there. And so, what the complaints of ESG are, it's very unstructured data. Great, machines don't care. Another complaint is that it's atomized across dozens of small niche data providers, employee sentiment, employee turnover, community sentiment, all sorts of patents, all sorts of small data sets. Machine doesn't care. It can aggregate and crawl through that data seamlessly. And it can be very noisy data. It's not like it's sitting in a nice spreadsheet and is in the same format. The machine doesn't care. It's just looking for information. So it's a huge win to apply some of these machine intelligence tools to ESG. And let me just share an anecdote, which I've shared before, but it's such an easy one for us all to grasp. Instead of thinking about just using it on the positive side, the risk management piece is huge. Yes. So take a company like Facebook back in 2018. a company that we've all followed our entire life, one of the strongest franchises you can have. What a business moat to have hundreds of millions of active users. In 2018, the privacy scandal emerges, reported by The Guardian and the New York Times, where 87 million users, their data was extracted by Cambridge Analytica. That whole story was bubbling in the blogosphere for months before it emerged in the mainstream media. And so here you have a company which has great recycling, has great standard ESG scores, but is, on the other hand, risking its entire franchise on the one thing that can bring it down. The one sovereign risk it has is to lose trust of its user base. And that's what it's dabbling with in the privacy scheme. So that's where looking at ESG is critical, because that one element can eradicate the rest of your investment thesis. It doesn't matter what they're doing as a business if over here they're an iceberg with data privacy. And that's where we see a lot of value in ESG, and that's where we're applying our machines to try to mine that value.
If I can just interject, this is a perfect, incisive example of how important materiality is. Right? So when it comes to certain industries, certain sectors, certain companies, if we are not getting to the data that matters, then we're just creating noise. Then it's just noise with no predictive investment insight. If we think kind of industry by industry, what matters, right? So if we're talking about a food company or a semiconductor company, we care about water scarcity. If we're talking about a mining company or a shipping company, we care about safety. Right? On the other hand, if we're talking about a financial services company, well, I'll use a technical term. We don't give a rat's ass about their, again, energy efficiency directly. We do indirectly in terms of travel and everything else. The point is, there is both a quantitative and a qualitative aspect of doing proper ESG analysis. And with the regulatory environment kind of moving forward, notwithstanding this huge backlash against ESG analysis, which some people would call ignorant, with the changes in the regulatory landscape, this is becoming a place where the impossible, seemingly, has become inevitable. And another thing that's raised here is when we think about the E and the S and the G, that G, governance, is first among equals. It all actually sits in governance. If a company is not thinking about the environment in which it operates, on the environmental and social landscape, then it is not well governed. Period. It's tautological. So we're going to go to a place where sustainability and impact and ESG analysis is axiomatic. That's where we're going.
Do you think it's better to think of it in the terms of sustainability and impact, and that the talk of ESG is sometimes a bit of a distraction?
Now it is, yeah, it definitely is. The terminology kind of confuses everything. We are just talking about investing. And by the way, sustainability, it doesn't actually go far enough. Carbon neutral, net zero, it doesn't go far enough. We have to go beyond sustainability. And we have to be talking about truly repairing some of the stuff that's gone on.
Yeah, and it leads to one element we haven't even touched on yet, which is very cool, part of the future of the business, is that now we can start to be much more sophisticated with new products, new strategies. Mm-hmm. So whereas we were in the past where we all have to anchor off performance, now that machines are much more involved, what we can do is isolate the alpha source, because you know where it's coming from, and instead optimize for something else. So for instance, you can say, or a institutional investor, CalPERS, could say, you know what, I want a strongly performing US equity portfolio, but I want it with the least amount of carbon emissions possible. And so a machine can look at that and you can get dramatic reductions in carbon emissions without sacrificing much outperformance, just statistically. And so once all these things are quantified, you can start to slice and dice with these really interesting new strategies. Someone could be interested in human rights, and you can optimize around that. So you get these value-based strategies that are able to be produced rather than just plain vanilla kind of equity box boxes. So this is this is the next wave that's coming as well.
Yeah, and I would also say, just looking at the other side of the coin, that AI and ML can also be an ESG risk itself, right? Because they require a huge amount of computing power, like we talked about. So that can be an environmental risk. And then there are these ethical concerns too, right? I mean, yes, the machines are looking for the data, but sometimes the data is biased, so they tend up reinforcing those biases. And of course, then there are ethical concerns related to all the private information that financial institutions have, and whether you can use ML to somehow take that data, access that data. So those are kind of the ESG and ML relationship exists in that format too, a slightly negative format, but that's also reality.
I was just going to say that's why I love the title of this session, like The Rise of the Machines. So Terminator is like my favorite all-time movie, and the whole series, right? So The Rise of the Machines, it's good, and it can be very, very bad.
Yes.
It can amplify what is not okay. So
the data's got to be right.
Well, that's the thing. So we move closer and closer to having higher quality rather than sketchy data. So when we think about the last 15 years, 20 years of the environment where we're building infrastructure for better data, I was one of the people involved with the SASB on founding. We went from SASB to the ISSB, and we're getting more and more. Now the SEC is talking about ESG disclosures. This is not easy, but it's really, really important. Standards for disclosure, transparency. Transparency really can be transformational, and it will be with AI and machine learning. But yeah, there's the rise of the machines is a little bit scary.
Gareth, could you give another example of how it can be used to really fuel outperformance?
Yeah, sure. So one of the things, let me even link that to greenwashing. So one of the things that CFOs and corporate treasurers are doing across corporate America is they're greenwashing their own books, right? Because they see the flows to ESG funds, et cetera. Right. I totally agree with all these points. So this is a little bit like the old days, the old Enron WorldCom days, where you would have earnings manipulation and you play with your cash flow numbers. So here they're playing on the ESG side. It's kind of a chess game. And who's good at chess? Computers. So the computer doesn't care that in page 262, line 17, there is a notation where it clarifies something that's a headline on page 2. The computer can look through some of that. Now, obviously, we have a long way to go, but it can do a better job at that than most. So this attempt at greenwashing by corporations can be looked through, a bit like the Facebook example. And that's a big part of what the machine is doing, because listening to myself here, I'm very far from being a techno-utopian, despite how it sounds. The one insight that's very useful with the application of these machine intelligence tools is that it's not that they're better than humans. It wasn't even the case when Garry Kasparov, the grand chess master, lost to the chess game or the chess computer program Deep Blue here in New York City in '97. He lost because he made a mistake, and that's actually how he references it. So the machines aren't necessarily better driving chess Go, they just make fewer mistakes. And they can look at things in an objective risk-reward way. So yes, they don't get bored, they don't need to go on holiday, they don't inside trade, they don't have career risk, and so they can read these notations and they can look through some of the chess playing that corporate America is playing with greenwashing their accounts.
And they're faster, right?
Yeah,
that also helps in outperformance because they gather data much faster. You can change weights of the various factors much faster. You can react to controversies much faster. So then asset allocation can be more timely. So that's another source of outperformance.
And think about ultimately.
And investment managers that aren't doing this, their lunch is about to be eaten.
Oh yeah.
Right? So we're talking about risks. The risk is for a institutional client or an investment manager, if you are not genuinely integrating these tools rapidly now, then your lunch is going to be eaten in the next wave of investment management, because that is where the outperformance is coming from, our view, human and machine together.
Right. And ultimately think about quantum computing. I mean, it's a ways out, but asset management is going to be dramatically affected. Think about our not just going faster with the machines, but simultaneously addressing, everything right away. Think about the positive of what that could mean for climate action, for carbon emissions, the transportation industry, the healthcare industry, personalized everything. When we ultimately get to quantum computing, there's going to be loads of companies and asset managers that are going to have their heads eaten. So it's going to be good, but there is a lot of risk. Right?
And despite all the kind of criticism of ESG and parts of the green agenda this year, investors are still wanting those customizable solutions. There's an increasing focus on it. There's a younger generation of investors coming through. So it's still only going in one direction, I'd have thought. So before my next question, let me ask the audience if there are any questions to ask my panel. Okay, I will proceed with, what is the one thing that most investors or the conventional wisdom is wrong about with regard to AI and machine learning or ESG? Who'd like to kick off? Gareth.
Great. I should have thought of something before.
You should.
So I think one of the big misconceptions would be that it's a game of deep learning and big data, right? That's the jargon. So if you're in the world of machines, you know very quickly that it's not magic algorithm, it's not deep learning, it's not big data. In finance, there's not big data, it's small data. Google, if Google is here, we can talk to them about big data. But we have a small data problem, ESG and investing generally. So it's a much more nuanced game than magic algorithm and big data.
Yeah. Sumali?
Sure. So I think one of the conceptions, I don't know if I should call it a misconception, but is that ESG works because it's biased towards large cap, it's biased towards growth, and that really ESG itself doesn't generate alpha, that it's more people who want ESG-focused strategies are doing it because it's aligned with their norms, their values, they want to mitigate climate risk or such things. But we actually have done research where we looked at high ESG risk portfolio and a low ESG risk portfolio and neutralized all the exposures, industry, sector, factor exposure versus the benchmark, to see how the performance of those portfolios would be. And we found that low ESG risk portfolios still outperform the benchmark, even though they look exactly the same as the benchmark in terms of sectors, industries, and factors. So that kind of leads us to believe that there is an ESG factor. And perhaps it is driven by the fact that there's so much money flowing into ESG, but there seems to be a separate factor there. So that's something that I can think of.
So I think the key factor is that ESG analysis is better investing, period. Why would you not want more information than less, right? And so it's simply an enhanced analytical approach that a lot of people, investors, are often doing, even if they don't know that they're doing it. But the work that you're doing highlights the fact that you need sacrifice nothing to integrate ESG into your investment process. Aside from that misperception, there's a myth, and it is a myth, and whoever's listening out there, there's a myth that ESG integration and analysis is breach of fiduciary duty. Not only is that not the case, but I would argue that a fiduciary that is not integrating material ESG factors is breaking their fiduciary duty of care, and they should be kicked out of the business. So that fiduciary duty myth really should be dead, and so we can all help to kill it.
And what are some of the kind of related themes that you're hearing about, when you talk to investors, Erika, about how they're kind of approaching this, and maybe ways in which they want to put it aside and say, stick to your knitting, whatever makes the highest returns.
I mean, again, from the research, and by the way, there are something like 1,200 empirical studies that show that you do not give up returns by virtue of ESG factor integration, all right? So we do have to kind of have a massive consciousness-raising exercise to make sure that people understand that. I will tell you that still a majority of investors are in the stick to your knitting, get me the best returns. And if that's what investors want, we absolutely do that. That doesn't preclude ultimately understanding our clients and helping them to align their assets with their values and not give up returns. But we still have a long way to go.
Yeah. And taking a long view, in 5 to 10 years, is it going to be a case of, investment strategies will either be purely systematic, or where there are discretionary strategies, systematic approaches are kind of weaved in? Is there going to be a role for human trading alone in 5 to 10 years? Gareth?
Yes, I think so. That would be another myth, that the computers will take over everything. It's not the case. There's a lot of research that human plus machine plus good process ends up being a better outcome. Think of Garry Kasparov with IBM's Deep Blue, right? That's the future. So that augmented intelligence is going to be a part of investment management. So machines can do certain things quite well. Humans and machines can do certain things quite well. And then humans, particularly things like venture capital, private equity, staring into the eyeballs of founders, that can be something that will remain human for a long period of time.
Yeah. Same goes for Xponance, Sumali.
Yes, I would agree with what Gareth said, because, financial markets are very dynamic, inconsistent, volatile. So you need that human intervention to apply machine learning. Otherwise, machine learning running amok is not going to really work. So that's a very important consideration. It has to be humans and machines working together.
Okay. We have less than a minute. Do we have any questions for our panel today? Yeah, go ahead.
Of course.
So machines for tailored solutions. Who'd like to take that?
I mean, we will probably all say the same thing, because once you have machines as a factory rolling out your investment processes, you have scalability, which is we haven't spoken about. But it means then you can develop a whole host of very bespoke strategies for folks very rapidly, like a Tesla rolling off at blue or red or X or S, as you wish. So that's the automation side of machines that is coming to investment management as well.
Good stuff. Okay, we will leave it there. Please join me in thanking my panel.
Thank you.